This question tests your understanding of the advantages of adopting International Financial Reporting Standards, IFRS. IFRS is a globally recognized set of accounting standards designed to improve the consistency, transparency, and comparability of financial reporting across different countries. The key phrase in the question is advantage of adopting IFRS. Students should focus on the benefits that arise from having a common accounting language used internationally. IFRS helps investors, lenders, regulators, and other stakeholders compare financial information more effectively, regardless of where a company operates. When answering this type of question, think about the main objectives of IFRS. Improve comparability of financial statements, increase transparency and investor confidence, facilitate international investment and capital raising, reduce barriers to cross-border business activities. Any option that promotes international consistency and comparability is likely to be an advantage of IFRS. Option A. It would be easier for investors to compare the financial statements of companies with those of foreign competitors. Correct. One of the primary benefits of IFRS is enhanced comparability. Investors can more easily evaluate companies from different countries because financial statements are prepared using the same accounting framework. This supports better investment decisions. Option B. Cross-border listing would be facilitated. Correct. Companies seeking to list shares on foreign stock exchanges benefit from IFRS because many markets either require or accept IFRS-based financial statements. This reduces the need for multiple sets of accounts and lowers compliance costs. Option C. Accountants and auditors would have more defense in case of litigation. Incorrect. IFRS does not provide special legal protection for accountants or auditors. Compliance with IFRS may support professional judgment, but it does not create additional legal defenses against litigation. Option D. The accounting standards can be more easily tailored to reflect the industries of the territory adopting them. Incorrect. IFRS aims for global consistency. Adopting IFRS actually reduces the ability of individual countries to customize standards to local industries or national preferences. Correct answers. A. It would be easier for investors to compare financial statements internationally. B. Cross-border listing would be facilitated. These advantages reflect IFRS' core objective of creating a common global financial reporting framework. This question tests your understanding of the two main approaches used in accounting regulation: principles-based systems and rules-based systems. The key requirement is to identify two true statements. Before evaluating the options, remember the fundamental difference. Principles-based systems establish broad accounting principles and objectives. Preparers and auditors must apply professional judgment to determine the most appropriate accounting treatment. Rules-based systems provide detailed guidance and specific rules for many situations, aiming to reduce ambiguity and increase consistency. International Financial Reporting Standards, IFRS, are generally considered more principles-based, while some national accounting frameworks have historically been more rules-based. To answer correctly, focus on whether the statement reflects the amount of detailed guidance required, the degree of professional judgment needed, whether the system attempts to address every possible situation. A principles-based system will require more detailed regulations than a rules-based system. Incorrect. This is the opposite of reality. Principles-based systems rely on broad concepts rather than extensive detailed regulations. Rules-based systems require more detailed prescriptions and guidance. B. A rules-based system will tend to give rise to a larger number of accounting standards than a principles-based system. Correct. Because rules-based systems attempt to address many specific circumstances, exceptions, and special cases, they typically result in more detailed standards and a greater volume of regulations. C. A principles-based system seeks to cover every eventuality. Incorrect. Covering every possible situation is a characteristic of a rules-based approach. Principles-based systems provide general principles that can be applied to new or unusual transactions. D. A principles-based system requires the exercise of more judgment in application than a rules-based system. Correct. Since fewer detailed rules exist, accountants must apply professional judgment when interpreting and implementing accounting principles. This flexibility is a key feature of principles-based regulation. Correct answers. B. A rules-based system will tend to give rise to a larger number of accounting standards than a principles-based system. D. A principles-based system requires the exercise of more judgment in application than a rules-based system. Exam tip. When comparing principles-based and rules-based systems, principles-based equals fewer rules, more judgment. Greater flexibility. Rules-based equals more detailed guidance. Less judgment, greater consistency. This distinction is frequently tested in program, financial reporting, and corporate reporting examinations. This question tests your understanding of the due process followed by the International Accounting Standards Board (IASB) when developing a new international financial reporting standard, IFRS. The key focus is on the early stages of the standard-setting process and how the IASB identifies and evaluates important accounting issues before drafting a new standard. Students often confuse the sequence of documents issued during the process. Remember that the IASB aims to gather opinions from stakeholders, regulators, preparers, auditors, and users of financial statements before introducing new requirements. However, before publishing formal consultation documents, the IASB first works to identify the key issues through discussions with specialist groups and advisory bodies. A useful way to remember the process is 1. Research and consultation stage. Identify issues and gather preliminary views. 2. Discussion paper optional but common for major projects. Obtain public comments on possible approaches. 3. Exposure draft. Publish proposed requirements and seek public feedback. 4. Final IFRS standard. Issue the completed standard. The question specifically asks about the early stages, making it important to distinguish between consultation activities and formal publication of documents. A. In the early stages of the project, the IASB will issue a discussion paper to obtain views from the public. Incorrect. A discussion paper may be issued later in the research phase, but consultation with advisory groups occurs before or alongside the development of proposals. B. In the early stages of the project, the IASB will consult with the Advisory Committee and IFRS Advisory Council to seek out the key issues. Correct. During the initial stage, the IASB consults advisory bodies and stakeholders to identify and understand the major accounting issues that need to be addressed. C. In the early stages of the project, the IASB will issue a discussion paper, then consult with the advisory committee. Incorrect. The sequence is wrong. Consultation with advisory groups occurs before formal public consultation documents are issued. D. In the early stages of the project, the IASB will issue an exposure draft to obtain views from the public. Incorrect. An exposure draft is issued after significant research and development of proposals, not at the beginning of the process. Correct answer. B. In the early stages of the project, the IASB will consult with the Advisory Committee and IFRS Advisory Council to seek out the key issues. Exam tip. Remember the progression: consultation, discussion paper, exposure draft, IFRS standard. Questions often test whether you can identify where each activity fits within the IASB's due process.